The stock market can feel unusually unstable in 2026, but it helps to remember one key idea: prices move on expectations. When investors aren't sure what the future looks like, they react faster and more dramatically to new information. First, interest rates still matter a lot. When rates are high or changing direction, investors constantly reprice stocks. Higher rates can make borrowing more expensive for companies, and they also make safer investments, like bonds, more attractive. Even small hints about future rate cuts or hikes can create big swings. Second, inflation and the cost of living remain a major uncertainty. If inflation appears to be returning, markets worry central banks will keep policy tight. If inflation falls too quickly, markets can worry that demand is weakening and a slowdown is coming. Either way, the same data point can be interpreted in different ways, which fuels volatility. Third, economic growth is uneven. Some sectors may be doing well while others slow down. That creates a push and pull. Investors rotate money quickly between industries like technology, energy, financials, and consumer goods, which can make the overall market look jumpy. Fourth, corporate earnings are under a microscope. In unstable periods, investors care less about stories and more about numbers: revenue growth, profit margins, and guidance about the next quarter. If a company misses expectations or gives cautious forecasts, the stock can drop sharply, and that can spill over into the rest of the market. Fifth, global and political risks can amplify moves. Trade policies, geopolitical conflicts, elections, and regulation can change the outlook for supply chains, energy prices, and corporate costs. When headlines change quickly, markets tend to swing with them. Finally, market structure plays a role. Fast-moving algorithmic trading, heavy use of options, and sudden shifts in investor sentiment can magnify price moves, especially on big news days. So, the stock market feels unstable in 2026 because multiple big variables — rates, inflation, growth, earnings, and global risks — are all moving at once, and investors are constantly updating their expectations. The best way to navigate that is to focus on long-term goals, diversify, and avoid making decisions based on a